On October 16, 1973, Saudi oil minister Ahmed Zaki Yamani entered the Sheraton Hotel in Kuwait City and informed six Persian Gulf oil ministers that they were going to unilaterally determine the price of oil. They weren't going to ask or negotiate, they were going to set it. This wasn't for the next quarter or after consulting with oil firms. It was happening immediately. Within hours, the listed price of crude surged from $3 to $5. Within 3 months, it reached nearly $12. Within a single year, the American economy, the most powerful on the planet, was brought to its knees. Gas lines stretched for 5 miles. Fistfights broke out at service stations. Truckers shot at one another on Pennsylvania highways, and the stock market surrendered half its value. That was the reality of 1973. Today, the Strait of Hormuz, the critical choke point through which 1 out of every 5 barrels of global oil passes, is shut down for the first time in modern history. It isn't just threatened, it is closed. Iranian missiles are striking tankers, and insurance providers have withdrawn coverage. Oil is now climbing past $80 a barrel with no visible ceiling. The question you are asking yourself right now is the same one Americans asked in 1973, 1979, 1990, and 2022. When energy is transformed into a weapon, what do you actually own that retains its value? Before proceeding, understand that nothing in this video constitutes financial advice. This channel analyzes history. What you choose to do with that information is your own decision. Conduct your own research. We are historians, not brokers. The official narrative of every energy crisis is always the same. It is temporary, the government has it under control, and prices will soon stabilize. History, however, tells a radically different story. On November 7, 1973, Richard Nixon appeared on television to announce Project Independence, claiming America would be energy self-sufficient by the end of the decade. It was a falsehood before the words even left his mouth. American oil imports actually rose every year following that speech. His Emergency Petroleum Allocation Act established a two-tier pricing system that capped domestic oil at roughly $5 a barrel, while global markets hit $12 to $17. The outcome was exactly what any economist would have predicted. Domestic producers had no incentive to drill, and refiners could not secure crude. The government effectively created the very shortage it claimed to be solving. Despite claims of being temporary and under control, gasoline rationing arrived. By the final week of February 1974, 1 in 5 American gas stations had no fuel. The American Automobile Association confirmed these figures. New Jersey implemented the odd-even license plate system, odd plates on odd days, even on even days. Oregon, Massachusetts, and several other states followed suit. Drivers waited in lines for miles. In Maryland, those lines reached 5 miles long. Nixon signed the 55 mph national speed limit and requested that gas stations close on weekends. 90% complied, which paradoxically led to even longer lines during the week. In December 1973, striking truckers in Pennsylvania and Ohio fired upon drivers who refused to join them. In Arkansas, trucks were firebombed. This was America, not a combat zone, yet it was a gas shortage. Now let's examine the assets. Research across 5 energy crises spanning 7 decades. Suez in 1956, the 1973 Arab embargo, the 1979 Iranian Revolution, the 1990 Gulf War, and the 2022 Russia-Ukraine shock shows a consistent pattern. This pattern contradicts almost everything the financial press tells you during the first week of a crisis. Energy stocks are not automatic winners. This is the most critical finding, and it may surprise you. During the 1973 embargo, when oil prices quadrupled, a basket of the 8 largest American oil companies actually fell by 35%. Exxon reported a record $3 billion profit that year, and Texaco's profits doubled, but it didn't matter. The bear market overwhelmed the commodity tailwind. Investors sold everything, including the companies generating the most cash. Energy stocks only dominated over the full decade, returning more than 200% from 1970 to 1980, compared to roughly 50% for the broader market. The lesson here is about the time horizon. If you purchased oil stocks the week the embargo began, you lost money for a year and a half. If you held for 7 years, you made a fortune. In 2022, the pattern flipped. Energy was the only positive sector in the entire market, rising nearly 60% while the broad index fell almost 20%. Every single one of the 10 best performing stocks in the index was an energy company. ExxonMobil reported the largest annual profit of any Western oil company in history at $55 billion. Shell earned its highest profit in 115 years. Occidental Petroleum surged over 100% after Warren Buffett's Berkshire Hathaway quietly built a $12 billion position. Commodity trading houses made even more. Vitol earned $15 billion and Citadel earned a record $16 billion in a single year, with roughly half coming from commodity trades. However, this only worked because the broader market was not in a deep structural bear market. In a true crash, everything is sold. In a correction, the strongest sector leads. Gold requires inflation and easy money to surge. It doesn't just need a crisis. In the 1970s, gold went from $65 to $850, a staggering gain. But that decade was a perfect storm. Inflation hit nearly 15%, and the Federal Reserve remained behind the curve for years. The dollar was so weak that the Treasury issued bonds denominated in Swiss francs, known as Carter bonds, because foreign investors refused to hold dollar debt. The Soviet invasion of Afghanistan on Christmas Day 1979 added geopolitical terror to monetary chaos. Gold peaked at $850 on January 21, 1980, the day before Paul Volcker's rate hikes began to take hold. Then it fell for 20 years. During the 1990 Gulf War, a genuine oil shock, gold barely moved. The crisis was brief, inflation stayed low, and the Fed wasn't printing money. In 2022, gold ended the year flat despite war in Europe and 9% inflation because the Fed was raising rates aggressively and the dollar was surging to a 20-year high. Gold is not a crisis hedge. It is an inflation plus easy money hedge. This distinction is vital right now because the Fed's next move will determine if gold at current levels is the start of a run or the peak. Government bonds failed in every single energy crisis, every one. In 1973, yields rose. In 1979, they exploded to over 15%, marking the worst sustained bond bear market in modern history. 2022 was the worst bond year in 4 decades. Energy crises are inflationary events, and inflation is poison for fixed income. As oil surges past $80 and the Strait of Hormuz remains shut, the 10-year Treasury yield is climbing again. Bonds are protecting no one. The counterintuitive winner across 7 decades is not what you expect. It isn't oil and it isn't gold. It is logistics, the physical infrastructure that moves energy from where it is to where it is needed. During the 1956 Suez Crisis, oil prices barely moved, but tanker rates exploded by 1,400%. Aristotle Onassis, facing bankruptcy with an idle fleet, made $70 million in a single year because his uncontracted tankers suddenly became the most valuable assets in world shipping, earning $2 million in profit per voyage. He went from the brink of ruin to being one of the richest men alive in 12 months. His rival, Stavros Niarchos, profited from the same mechanism. The crisis did not reward the men who owned the oil. It rewarded the men who owned the ships. The mechanism wasn't the commodity, it was the choke point. Whoever owned the capacity to move oil around the bottleneck owned the crisis. That mechanism is playing out right now. With Hormuz shut and the Red Sea dangerous due to Houthi attacks, every barrel of oil reaching the market must travel around the southern tip of Africa, adding 10 to 14 days per voyage. Shipping rates are spiking, and insurance costs have risen 12-fold. Companies owning tankers, pipelines, and refining capacity outside the conflict zone are repricing in real time. The mechanism hasn't changed since Onassis. Only the instrument has. The second strategy that worked was being on the right side of the disruption, not in the commodity itself, but in what the commodity breaks. Japanese automakers understood this better than anyone. After the 1973 embargo, American car sales dropped from 9.7 million units to 7.5 million in 1 year. The big three were building land yachts averaging 13.5 miles per gallon. Nobody wanted them. General Motors, Ford, and Chrysler lost massive market share to Toyota, Honda, and Datsun, whose fuel-efficient cars were suddenly the only vehicles Americans desired. By 1980, Japan surpassed Detroit in global production for the first time. The oil shock didn't just move money, it permanently restructured an entire industry. The winners were the companies that solved the problem oil created. The third strategy is the one you least expect: farmland. During the 1970s, farmland values nearly quadrupled as crop prices doubled and tripled. The government told farmers to plant fence row to fence row, assuming energy-driven food inflation would last forever. Farmers borrowed against rising land values to buy more land. Then Paul Volcker raised interest rates to 20%. Iowa farmland lost 60% of its value, and 300,000 farmers defaulted. The suicide rate among farmers was 4 times higher than normal through the 1980s. The energy crisis of the 70s created the farm crisis of the 80s. Farmland wasn't the wrong asset. It was the wrong leveraged bet on permanent inflation. The mechanism worked, but the leverage killed it. Regarding whether this is happening again, the Strait of Hormuz carries roughly 20 million barrels of oil daily, 1/5 of global consumption. Saudi Arabia, Iraq, the UAE, Kuwait, and Iran all ship through it. Qatar sends 20% of the world's liquefied natural gas through the same channel. While bypass pipelines exist, they carry only a fraction of what flows by water. Iraq, Kuwait, and Qatar have no alternative routes at all. This is the first time Hormuz has actually been closed. During the 1980s tanker war, over 400 ships were attacked, but traffic was never disrupted by more than 2%. In 2011 and 2019, threats and drone strikes caused temporary blips, but prices recovered quickly. This time, the strait is shut. Insurance companies, not navies, are enforcing the closure. Cheap drone strikes triggered insurers to withdraw coverage entirely. War risk premiums surged 12-fold overnight. A single voyage now costs $250,000 in insurance alone. No insurance means no commercial shipping, regardless of naval escorts. Over 700 tankers are currently queued outside the strait. The damage is spreading. Qatar Energy has halted production at Ras Laffan. South Korea warns it could run out of gas in 9 days. And India is extremely vulnerable with only 25 days of crude reserves. This is a real-time restructuring of global energy flows. So what does history suggest you should do? 4 things. First, if you own energy stocks, hold through the volatility, but do not chase the spike. The 1973 precedent shows the first year can be brutal for energy stocks alongside the broader market. The full cycle returns are where the profit lies. Second, watch the Fed, not the oil price. If the Fed accommodates inflation, gold will rise. If they tighten aggressively like Volcker, gold will stall and bonds will eventually become the trade. Third, look at the logistics layer: shipping, pipelines, and refining outside the conflict zone. Onassis got rich because he owned the only way to move the oil. Fourth, do not leverage into real assets on the assumption that inflation is permanent. Leverage is how fortunes die during a crisis. The final insight from 7 decades of history is this: every energy shock ended not when supply returned, but when demand was destroyed. The 1973 embargo ended when a global recession cut consumption. The 1979 crisis ended when high interest rates crushed the economy. The 2022 spike ended with industrial shutdowns and lockdowns. Governments don't solve the supply problem. They wait for or engineer a recession severe enough to make the supply problem irrelevant. The question isn't when the strait reopens, but how much economic damage the world will endure before demand falls far enough to make the price of oil stop mattering. If this analysis of the hidden forces behind energy crises has changed the way you look at the global economy, please subscribe and like this video. We are dedicated to uncovering the history that often remains buried beneath the headlines. Secure your financial future by understanding the past. The next chapter of our historical investigation will be opening soon.